When you think about getting better investment returns, for most people, they think about finding better stocks, finding better cryptos, finding better investments overall. And that's part of the equation. But the bigger part of the equation, at least according to academic research, is managing yourself, managing your emotions, your psychology, your actions, what you do. We're hardwired for a different world, not a probabilistic investing world, which we invest in. To better unpack this topic, joining me today is Professor Victor Ricciardi, or Victor Ricciardi, I should say, who's on the finance faculty at the Tennessee Tech University. Vic is one of the world's foremost experts in behavioral finance. He has several books out: Investor Behavior, Financial Behavior, and coming this summer, a new book called Advanced Introduction to Behavioral Finance. So, Vic, thank you very much for joining us today.
Oh, great. Thanks for having me. I always enjoy talking about investor psychology, behavioral finance, even financial history, and another passion of mine is financial literacy.
That's because we're all noble passions. And you and I have known each other for a while. It's always great to talk to you, and I appreciate your being so generous with your time. So let me just swerve a little bit and do a quick lightning round, a snap judgment lightning round, because we always like to know who we're hearing from. And I think the audience might appreciate just some kind of personal, candid questions. So just quick answer, very quick answer. Don't overthink it. Last vacation spot.
Last vacation spot I think before the pandemic was either Las Vegas or maybe Myrtle Beach.
Maybe. Okay. I had to think about that one. It's been a while. Hope you can take another
Yeah,
vacation soon.
yeah.
Favorite food?
Yeah, I would say, because I'm Italian American, pizza, anything related to pasta, and also I'm a pretty good cook. So I make a very good tomato sauce, by the way.
I
We can have an
believe that.
episode on that sometime.
I believe that. Towns are hardcore about their food. Fiction or nonfiction? Mostly.
I would say nonfiction.
That's my guess. Long talks or long walks?
Probably long talks, but I can walk at the same time and talk. So.
You're right. There's no need to choose, right? So cool. All right. So with that said, let's get to the meat of behavioral finance. So, Vic, let me first question: what is the case writ large for behavioral finance, and how big of a role does bias play, or just I guess the behavioral aspect of humanity play in people's long term investment returns?
Well, I would say especially the idea now that we've had really change in not necessarily economics, but a change in interest rates. So we had and this is understanding financial history, we had essentially a 10 to 15 year episode. You could talk about the financial crisis, but we had very low interest rates. So the financial advisors have come up in the last, you know, almost generation now, and even investors, until 2 years ago, everything was growth, growth, growth. Now, people are going through the realization, and this is where they suffer from complacency, and maybe they realize things have changed with higher interest rates and inflation, but they don't necessarily understand that they should be investing differently. And that complacency is now known as status quo bias, where we kind of just accept the current state, but we don't recognize the state has changed. And so people still hang on to the notion of not wanting to change from growth and then looking at maybe a value stocks, which are, the idea of looking at energy stocks, looking at hedges against inflation, looking at things like I bonds, and looking at high dividend paying or yielding stocks or mutual funds as simple and boring sometimes is the other way to counter a changing environment. But ultimately, I think what we're looking at now, we're trying to get guys is, are interest rates and inflation going to subside in the next year or two, or is this going to be something that happens for the next 6 to 8 to 10 years? A wonderful benchmark that people, and this is where financial history is important, going from the late 60s to the early 1980s, every time the Fed was trying to tamp down inflation, they didn't do enough. So essentially, depending on how you look at the data, we had maybe a 12 to 15 year period in which the market went sideways. So I think if you're looking at a rational portfolio right now, we don't know what's going to be a success, or we're going to cause recession, if the Fed's going to overshoot. So the rational thing is to have a portfolio that is structured for a non-inflation environment or lower inflation, or if inflation is going to persist, having an inflation protected portfolio as well. So I think it's having
And it's tough to
both.
have all those at the same time in a way.
Yes, well, it's structuring the idea of a correlated portfolio. I mean, it doesn't have to be overweighted perfectly, but I think at least, okay, if you want to have more growth, fine, but you still should have items that are not correlated perfectly with those growth stocks as well.
Well put. Let me just you mentioned status quo bias, Vic. That's certainly one bias. We just float along with the tide. What are some others, especially some of the bigger biases that derail investors?
The most proven one in the literature is overconfidence, and people just in their own abilities, whether especially men as men, we tend to trade too much. We don't have that patience. We also chase returns.
We don't ask
Um,
for directions either. Yeah.
yeah, also that's also the seminal study by O'Dean and Barber in the early 1990s showed that men tend to be overconfident. They trade more, and they get lower returns. And in that study, their hypothesis was women are essentially less confident, not necessarily less confident, but not overconfident as much. They tend to be more analytical, so they got higher returns because they weren't trading as much, and that's pretty significant. And then the argument there would be something like overconfidence. My colleague John Nossinger always has this open-ended question: is it nature or nurture? Meaning, look at neurofinance, men have more testosterone, so maybe that's why we trade too much. Or is it experience in the financial industry that as we do more and more things, maybe that builds and we have success, that builds the overconfident behavior as well. So I would say it's a combination of issues. And then another important one would be loss aversion. People feel the pain of a loss on the downside, and they hold on to losers too long. On the upside, they sell winning stocks too quickly, and that's essentially known as a disposition effect related to loss aversion as well.
Great points. We're really hardwired. We were evolved for a caveman world, a deterministic world where if somebody was confident where the water source was, he was or she was probably right. But in a stochastic and a probabilistic situation like economics, which is a social science, those like innate survival mechanisms, let's say, actually don't serve as well, and so it's almost a matter of undoing them. One question I'd have, Vic, is how feasible is that? In other words, like can we really, is awareness enough, or what kind of like safeguards or breaks or actions can we take to mitigate, to reduce the effect of these natural biases which tend to lead us astray?
And this is a conversation that I've been having more lately with financial professionals, and even trying to get, even among I think academics in behavioral finance and general finances, we've done a great job of now detecting the behavior, making the assessment behavior, but having a real, maybe at the margins, we've changed some behavior, but if you look at returns like the Delbar study and all things like that, for the
Yep.
average investor, does a very, the returns still are not great. When you're looking at, if you're looking at an average equity fund, and that's because I think it's financial education. It's not having a diversified portfolio, but it's also chasing returns, herd behavior, and that type of behavior leading to subpar returns. And also, is it also a part of the financial advisors who are trying to manage their clients? I think, and this other conversation I have is, with either brokers or advisors or planners, is the feeling that they struggle with is, and I have this with my students. Do you tell them what they need to know, or do you succumb to what they want as in terms of their investments? And many times, I think it's a struggle that the conflict with the advisor or the planner is: do they lose their client if they're not adhering to what the wants of the client, because they can take their money and walk away. So I think that's a major thing to think about. And the migration of the changing that behavior is, I think there's a balance between what I would call behavioral coaching and financial therapy. So overconfidence. if you don't even have, you can look at it two ways. You can ask somebody how. So if you say to somebody, for example, um, let's say the average return of a large cap stock is 8% historically, and you can ask somebody, do you expect a 6% return, an 8% return, 12% return, or higher than 8% in your portfolio next year? If they forecast returns higher than 8%, they think they're above average. So that's a way of thinking about overconfidence. The other way to assess it is if you were a broker or a brokerage firm or investment house, and you had, let's say, 100,000 accounts, and you looked at the number of times people are making trades in those 100,000 accounts. If people are moving around their money like a standard deviation way above average, let's say the average trades are 5 a year within that $100,000 database.
Mhm.
If someone's doing 25 trades, 50 trades, or 100 trades, that's probably overconfidence. And so that's where the advisor can make a behavioral or intermittent, an intervention, if you want to call it, and explain to the client. So that would be what, and explain why, educate them, try to get them to have a financial plan, meet their objectives, and not trade so much. And if the behavior goes away, that was a good outcome of coaching. The therapy would be financial therapy problem would be much deeper, in which they have psychological problems where they can't help, they keep on trading. And so I think the advisor then is under a much different realm. There's even some firms, and this is very small, will give a reference to the Financial Therapy Association, because they actually have a credential now in which someone can, if they seek it, can get financial therapy. And so that's a much different discussion. And I think a lot of advisors would even be uncomfortable with that type of referral. But that's where I would say the migration and changing the investor behavior, I think that's probably the next big phase of this. And I hope that it will improve behavior. But honestly, I still think it's at the margins. I mean, if you have a really good client that's willing to learn, of course the behavior is going to. If it's the average investor that doesn't understand the markets, and they have emotional responses, or they're a married couple with different personalities, it's very. I don't think we've really seen
Yeah.
a substantial change in behavior. Now that we're able to diagnose this, I think we really need to think about changing, improving investor behavior and outcomes.
Well, a couple thoughts. First of all, I love the idea of financial therapy. It's almost like a Gambler's Anonymous kind of a thing. I mean,
Mhm.
I'm sure there's a stigma. It's hard to get people to get financial therapy, but
Yeah.
it's a very useful thing. For those who are not familiar with Dalbar research, Dalbar study, I think they're most known for every year. They really put out a study showing, the average return, average mutual fund did this, but the average mutual fund investor did this. And it's basically always meaningfully lower. Like in one, I forgot the year, but it was 18% was the average fund, and then the average investor got 11%, and whatever. I'm forgetting the
Mhm.
year, but it's always something like this. The average
Yeah.
person does much worse. If you're new to that study, uh, uh, it sounds like what you're saying very clearly is that there's not that much success we as a society are having with removing these biases. There are some instances, and the people who are like kind of the most self-aware and the most eager to remove them maybe can get rid of them, but the people who probably need the help the most are at least able to get it. But in a way that's good. If you can be that one guy, if you can be the person who can think more logically, all that irrationality, that buying and selling for rational reasons is what's creating profit opportunity. That's sort of like creating alpha, right? I mean, if I'm competing against other people who are less rational than I am, and if I'm Warren Buffett, very level-headed, finance seems to suit very level-headed, kind of unemotional personalities, and that's probably a stereotype. But I think there's some truth to that stereotype. You get where I'm coming from, right? If I can be that rational person in a market where most people are not, I would seem to reap benefits.
Yeah, and that's what I mean myself. I have those biases. I believe in the traditional models of standard finance and rationality. I tend to disagree with the underlying assumptions. So if you can if you accept that, and you can at least have an understanding of the biases you suffer from, then put in place a non-emotional strategy, And hopefully that will, so when the market does certain things, if you keep on using things like dollar cost averaging, rebalancing, and really have an automated, thorough, diversified portfolio, either with mutual funds or ETFs, um, I think that's the way to go. And so that's what I do for myself. And I think the bigger question, other question that I think is that we are still struggling with, it's not all behavioral finance, it's also financial literacy. And, this is not a problem that has occurred overnight. It's really been more in the last three generations. So the first credit card, I believe, wasn't issued until the late 1950s. So the access to credit and credit cards is fairly new in the last couple of generations. And so people aren't educated with that. They don't understand interest. Also, what spurs on that spending is that, and why we don't invest is we suffer from self-control biases. So the same, and I think I mentioned this on earlier episodes with you. The same part of the brain that likes pizza, food, sex, music,
Pizza,
also
pasta,
likes,
rock music, and sex. You said last
yeah,
time. I remember that. Yeah,
yeah,
yeah.
yeah. And so that money part of the brain is, we are really inclined to spend money. And so even I joke to my students, I tell them I have 250,000, 250 items, which are probably worth $5,000 sitting on my Amazon wish list. And so that's a bunch of stuff that's not sitting in my apartment slash house or in storage that I didn't buy. And that's money that went into retirement. So that's the one piece. The other piece on the investment side is the 401k moving towards that, which is I understand people switched jobs in the 1980s, and the idea that the companies didn't want to give traditional pension plans. But the biggest hole, or the biggest drawback of that legislation is the idea that all of a sudden the average investor is going to be able to design an asset allocation strategy for their retirement account is completely, I would say, nuts. And that they didn't give more fiduciary responsibility to allow an advisor or even human resource, or a context of human resources, or having individuals make those decisions more proactively, is a hole in that registration. I don't know how you rectify it, but that's why we're not all of a sudden very dumb. We're all of a sudden, we were expected to make these decisions. Where if if you don't have a financial personality, or if you're not in finance, the average person doesn't know how to make these decisions.
Yep.
And now we're struggling with, as a country, of trying to integrate personal finance, because I teach a lot of these classes. All of a sudden, we're trying to ramp up the idea that we're going to be able to educate people in a thorough way. It's going to take at least a generation, but then also you have to be able to deliver programs. You have to have money and resources behind that to even. So that's why we're trying to improve investor behavior. We need to improve investor education as an underlying theme into that behavior to improve outcomes as well. So that's why I would say it's financial literacy plus investor behavior plus understanding financial history, which is another thing we don't even teach in most finance programs as well.
Yeah, I mean, we have a K through 12 educational system that's still implicitly modeled after, a couple hundred years ago system that was used to teach the European aristocracy just to be cultured. And, we didn't have to work. You lived this cultured life. You had family money. And I'm not against, Greek literature and art history, things like that. That's all great. But we also need practical skills. And that deficit is hurting our society. I totally agree with you on that, Vic.
Yeah, yeah, it's a wonderful thing that a lot of the state legislatures are, I don't know if we're up to 15, 20 in any state, but now at least mandate at least one personal finance course through K through 12. The problem is that now the next thing is we need to put resources behind that, but also we need to have people to teach those. So, I once went to a meeting. It was either like the FDIC or Federal Reserve or local, and I thought it was a meeting about financial literacy. I thought it was going to be college professors. What it was K through 12. So I was the only finance person there. All the K through 12 people were either economists, social studies teachers,
Oh,
even scientists were teaching personal finance.
wow.
because the other barrier to entry is even someone like me. I'm able because I have a graduate degree. I'm able to teach at the college level, but I don't have the certification in education to allow me to teach the lower grades. So the education system is designed to teach people to be good teachers, but not especially not necessarily to specialize in being able to teach business, accounting, or even personal finance. So it's a major policy issue on how we resolve that. So that's also been a passion of mine as well.
Yeah, that's great. I hope that continues for you. I taught briefly, volunteer, just a personal finance curriculum in inner city schools, kind of not schools, but a weekend program to middle school kids, and they were surprisingly interested. I thought they just were not going to care at all, but I was impressed. They like learning about investing. Let me shift gears though, Vic. You have final question. You've been an editor for SSRN, Social Science Research Network, which is, if you're not familiar with academia, that's where essentially all the academic papers flow through, at least a lot of those in the US in certain subjects. So like if you want to publish, it goes through SSRNs for 17 plus years. You've been editor of a few journals there, if I recall correctly. What are you
Mhm.
most excited about in the research, or what do you see as the future of behavioral finance research now?
Well, I think, and this is really just trying to improve. And Mayor Stoutman and others call this like a second generation. So
Mayor's a
I
great
don't
guy.
think,
He's a really good guy.
yeah. So they haven't really talked enough about, I think, improving outcomes for investor behavior. But I see that we are starting to at least look at things like, so there's a capital asset pricing model talking about the idea of having a behavioral capital asset pricing model.
Mm-hmm.
So I think a lot of it is we don't have enough tools and enough, we're still developing enough of a grounded theory that we can test. Because again, the traditional models are very wonderful because they're very clean with the data. You're able to say everybody is rational, and so you can put into models statistically, um, I would say, stock prices and things like that. It's not always easy to invest, come up with a proxy for for measuring certain investor behaviors. So I think as that advances and more people are doing doctorates in this area, but also as the CFA, and the CFP, the financial planners, start to become more academically rigorous, that will start to be more ingrained. And then, there's areas like neurofinance, also areas looking at biology, and there is more and more, especially every business student has to take a what you call corporate finance or managerial finance, and in that class that I'm teaching, I am essentially I'm a behavioralist, but I have to teach it I'm teaching it from a rational perspective. Well, Hersh Sheffrin has really been a leader in this field, so he's been giving more ideas to the idea of a behavioral corporate finance. And so, as these areas spread, as there's more interest in them, I think even like CFOs and the CEOs make decisions that they're not choosing always choosing the most optimal project. They have a personality driven issues. Also, if you put $100 million into an EV project, and you realize 5 years in it's a loser, it's very hard even for a CFO.
Very hard.
CFO,
Yeah.
you have that ego
Mm-hmm.
of admitting that you made a mistake, the board, and so why not? I know it's an investor's money, but you know, they're going to talk. They may talk themselves into, okay, I'm going to be able, with overconfidence, I'll be able to overcome that, or the idea they're loss averse, they have sunk costs, and they'll put another 5 to 10 to $15 million in the project with the hope of wishful thinking. So, and that's what, and so my first book, I would say, versus my second book, especially the second book, Financial Behavior, it kind of demonstrates that all parties, and institutional investors, the portfolio managers, the endowments, uh, portfolio financial advisors suffer from bias, and then the retail investors also suffer from bias. But I would say, if you're comparing the two as a general groups, that the retail investors suffer from greater biases than the institutional. And then also, since the institutional, depending on who they are, I think they're more open if they know they have bias, to correcting that behavior. Where the retail investor, again, it's education, bias, and correcting their outcomes and understanding financial history, that it's very hard to change their behavior.
Yeah, it's just the reality. But it sounds like what you're saying and is more of a fusion. I mean, in the old days, people who aren't familiar with this, there was traditional finance, which is sort of assumed a very rational person, which we know is completely not true. But that was the assumption, is it makes the math work a lot easier. And then behavioral finance popped up, really over the past 30 years or so. In the beginning, it was kind of ostracized, and a lot of the traditional people looked down on it. And eventually, it kind of broke through that barrier, and now it's more equal footing. But it sounds like you're talking about maybe we'll start to see a merge of these two things intertwined into one field, which I think is the deserved outcome. Hopefully that does happen.
Yeah, I mean, again, it's I look at it as it's Richard Thaler would say it's really there is no behavioral finance, for example, or traditional finance. He says it's just finance. So hopefully we get to the point where, and I view it also when I'm presenting with students. If you're teaching if you're talking politics to somebody, or you're teaching a political class, you would want to give them about the economy or something. I would hope you give them the Republican version and the Democratic version, and let the student decide on their own. So what I try to do is I try to present the students with the rational version, disclose I am a behavioralist, but I try to give them both issues. Also looking at, maybe I'll have them take surveys, thinking about what type of risk taker they are. Are they driven by personality? So I think ultimately what I think is important to think about is, as a closing point, that the people who are more quant, who think they're completely rational, you want them to at least have a little bit more understanding of behavioral finance, because that brings them more to the center of understanding, okay, not just standard finance, but maybe there's behavioral components to how to make decisions. Versus the behavioral people who are more gut making decisions, not looking at data, not liking quant models. You want them to be a little bit more quant. So you have that balance. So the way I talk to my students, I teach a lot of times, I use a lot of examples from Shark Tank. I think we want to have a balance of being Mr. Wonderful, which would be more of the standard finance person, and Mark Cuban, who has a gut feeling when he makes some decisions. And you want to have that middle ground, and so you want to be able to make decisions that maybe incorporate both of those people or perspectives.
Vic, you're always informative. It is my privilege, my pleasure to interview you. Thank you very much for your time. I think it's been useful to everybody listening as well. I hope it has been and watching. I will keep a lookout for your book, Advanced Introduction, right, to Behavioral Finance. It sounds like an oxymoron, advanced introduction, but
Yes.
that's intriguing, and I want to check out the book for that reason. Coming this summer, Vic Ricciardi, I should say, finance faculty at Tennessee Tech University. Thanks so much for joining us, and thanks to you guys for watching at home. And if you got thoughts about this, if you got stories, questions, feel free to post a note in the comments or drop an email. Happy to see what you got to say. Thanks so much, guys.
Thanks for having me.